Ladies and gentlemen, folks, if you own gold or silver, you need to stop what you're doing and pay attention. Right now, we are on the verge of a massive price movement, something that could reshape the market and your portfolio. This isn't speculation. These are real signals from the market, and history shows us that ignoring them could be costly. So buckle up, because what I'm about to share could change the way you think about your investments today. Folks, right now we are standing at a critical juncture in the metals market, and I cannot stress this enough. If you own gold or silver, your attention needs to be focused on what is happening this very moment. Over the past several months, we've seen a quiet storm building beneath the surface of the market. Signals that don't make headlines, but have profound implications for anyone looking to preserve and grow their wealth. These signals are not random. They're driven by the underlying fundamentals that have always governed precious metals. And ignoring them is a mistake you can't afford to make. We are witnessing extraordinary pressures building in multiple directions simultaneously. On one side, central banks around the world continue to manipulate interest rates, pumping liquidity into the system in ways that may seem benign at first glance, but ultimately erode the purchasing power of fiat currencies. On the other side, global geopolitical tensions are creating uncertainty in trade, supply chains, and energy markets. Both of these factors, when combined, have historically acted as accelerants for precious metals. Gold and silver are not just commodities. They are insurance against a system that increasingly seems unstable. The signals are flashing, and the market is already reacting in subtle ways that most investors overlook. The first thing to understand is that volatility is coming, and it is coming fast. Price charts tell part of the story, but the real story lies beneath the numbers. Physical demand is rising quietly but steadily, while the paper markets, futures, contracts, and ETFs are showing signs of strain. We've seen unusual positioning by large players with hedge funds and institutional investors increasing their exposure to metals in ways that signal anticipation of significant upward movement. This is not a casual trend. This is calculated positioning based on experience and deep market insight. When the smart money moves, it is often the first sign of what the broader market will do. Let me be clear. This is not the time for casual observers. The signals we are seeing indicate that gold and silver could move sharply, and when they do, it may be rapid and dramatic. In past cycles, we've witnessed single days where silver can jump 5, 7, even 10%. Gold, while often slower, can surge in ways that catch even seasoned investors by surprise. History doesn't always repeat, but it rhymes. And right now, the conditions are eerily similar to moments in history when metals spike due to fear and uncertainty in the broader economy. You also need to understand the global context. Inflation, often reported as moderate in official statistics, is far more aggressive in real terms. The cost of living is rising, and central banks' interventions have only delayed the inevitable adjustment in the value of money. When the system corrects, as it inevitably will, the impact on gold and silver prices will be pronounced. Those who are already positioned with physical metals are in a strong place. Those who are not are at risk of being caught on the wrong side of a rapidly moving market. The urgency is real because the window for entry, or at least for hedging, is narrowing. Another critical point is the psychological aspect of the market. Investors often wait for confirmation before acting, but in markets like this, waiting too long can be costly. Gold and silver are assets that move in anticipation of economic stress, not in reaction to it. That means by the time most news outlets report a crisis, prices have already adjusted. Savvy investors recognize the signals early, positioning themselves while the opportunity is still available. Right now, those signals are becoming unmistakable. Physical demand is increasing. Large institutional players are quietly accumulating, and the global monetary system is showing signs of strain that cannot be ignored. It's also worth noting that silver in particular is extremely sensitive to both industrial demand and monetary fear. This dual role as both a commodity and a monetary metal creates unique volatility. Gold, the more traditional, safe haven, tends to react slower but provides stability in the long term. Together, they offer a combination of protection and opportunity that few other assets can match, especially in times of uncertainty. Those who understand this relationship are watching the current market closely because it rarely offers such a clear alignment of conditions favorable to metals. At this point, it is crucial to think about your own position. Are you holding sufficient physical metals? Are you aware of the exposure you have in paper-based instruments that may not perform in the way you expect during extreme volatility? The difference between preparation and hesitation can be measured not just in lost gains, but in lost security. In times like these, hesitation is costly, and knowledge combined with action is powerful. I urge you to take a step back and look at the bigger picture. The signals are not subtle. They are consistent and converging. Central bank actions, geopolitical uncertainty, inflationary pressures, institutional positioning, and historical patterns all point in one direction. Gold and silver are poised for significant movement. The urgency is not a marketing line. It is the reality of the market environment. Those who recognize it now have the opportunity to make thoughtful, informed decisions that could protect their wealth and even position themselves for substantial gains. In short, the market is sending a warning, and it is loud enough to be heard by anyone paying attention. The metals are speaking, and if you own them or are considering owning them, you need to understand the forces at play. This is a moment to observe carefully, act decisively, and above all respect the signals that history has repeatedly validated. Ignoring them could be costly, but understanding and preparing for them could make all the difference in preserving your wealth in the months and years ahead. Understanding gold and silver requires more than just watching price charts. Too many investors treat these metals as if they move randomly, responding only to headlines or hype. The reality is far different. Gold and silver are deeply tied to the fundamentals of the global economy, the stability of currencies, and the interplay between supply and demand. Anyone who owns these metals or is considering doing so needs to appreciate the forces driving their prices and the historical patterns that offer clues to what might come next. Without this insight, ownership is speculation at best, and at worst a missed opportunity to protect and grow wealth. First, consider the role of money itself. Gold and silver are not just commodities, they are money in its purest form. Unlike fiat currencies, which can be created at will by central banks, these metals have intrinsic value. They have served as a store of wealth for thousands of years because they are scarce, durable, and widely recognized. This scarcity is more than physical, it is psychological. People trust gold and silver because they know that unlike paper currencies, these metals cannot be devalued overnight by printing presses. When confidence in paper money erodes, demand for these metals rises. Understanding this principle is essential to interpreting market movements and anticipating price trends. Next, examine the balance of supply and demand. Mining production for gold and silver is limited and expensive, and the rate of new supply is relatively predictable. At the same time, industrial demand, particularly for silver, continues to grow. Silver is used in electronics, solar panels, medical equipment, and numerous industrial applications. When demand rises while supply remains constrained, price pressure naturally increases. This fundamental relationship is often overlooked in short-term trading analysis, yet it is one of the most reliable indicators of long-term price behavior. Investors who grasp this dynamic have a significant advantage over those who focus solely on daily market fluctuations. Another critical element is market manipulation in paper markets. Futures contracts, ETFs, and other derivative instruments often obscure the real price discovery of metals. Large financial institutions can exert influence over these paper markets, creating artificial price suppression or volatility. However, physical ownership is immune to these distortions. Recognizing the difference between paper signals and the underlying physical market is a form of insight that few investors fully understand. When institutional activity signals accumulation of paper positions, it can indicate an anticipation of rising prices, but only those holding the metals themselves will fully benefit from the eventual market correction. History offers a third layer of education. Looking at past cycles, we see clear patterns of how gold and silver respond to economic crisis, inflationary periods, and financial instability. For example, in times of rapidly rising inflation or geopolitical uncertainty, precious metals consistently outperformed other assets. These patterns are not coincidences. They reflect the inherent qualities of these metals as stores of value and safe havens. By studying historical movements, investors can gain perspective and avoid the pitfalls of reacting emotionally to temporary market noise. Knowledge of history in this sense is more valuable than any short-term market prediction. Education also means understanding the global economic context. Interest rates, currency policies, trade imbalances, and geopolitical tensions all influence gold and silver prices. For instance, when central banks keep interest rates artificially low, the opportunity cost of holding non-yielding assets like gold decreases, making them more attractive. When currency values are uncertain, the purchasing power of money erodes, driving individuals and institutions toward tangible assets. Insight into these macroeconomic forces allows investors to see beyond headlines and understand the structural drivers of the metals market. Furthermore, insight comes from recognizing the behavioral aspect of markets. Investors often follow trends rather than fundamentals, buying when prices are high and selling in panic when prices drop. Metals, in particular, are prone to sharp swings driven by sentiment rather than intrinsic value. Those who are educated in the underlying dynamics of gold and silver, however, are less likely to be swayed by emotion. They see volatility as opportunity, not threat. They understand that short-term fluctuations are often noise, while the long-term trend is determined by fundamental scarcity and global economic pressures. Finally, education and insight empower decision-making, owning gold and silver. Without understanding these principles is like navigating a stormy sea without a compass. Knowledge equips investors to position themselves intelligently to buy when the market is undervalued and to recognize warning signs before prices move dramatically. It provides clarity in uncertain times and helps investors distinguish between speculation and strategic wealth preservation. Insight allows you not just to hold metals, but to understand their role in your portfolio, in your broader financial strategy, and in the preservation of your wealth against forces beyond your control. In short, the market is speaking, but only those who listen with knowledge and insight will understand its message. Gold and silver are not random. They are predictable when studied through the lenses of scarcity, historical patterns, macroeconomic forces, and behavioral tendencies. The more you educate yourself about these fundamentals, the better equipped you are to make informed decisions, protect your wealth, and seize opportunities others overlook. Investing without this understanding is risky, but with it, gold and silver become far more than commodities. They become powerful tools for preserving and growing financial security. At this point, the discussion shifts from understanding the market to acting on it. Knowledge and insight are essential, but they are only valuable if translated into thoughtful action. For anyone who owns gold or silver or is considering it, the key question is simple. What should I do now? The answer isn't one size fits all, but there are clear principles and strategies that can guide decisions in a volatile and unpredictable environment. These actions are not speculative guesses. They are grounded in historical evidence, market behavior, and sound wealth preservation strategies. First, consider the importance of holding physical metals. Paper instruments, ETFs, and futures contracts have their place, but they do not offer the same security as owning gold and silver outright. Physical ownership protects against counterparty risk and market manipulation. It ensures that regardless of what happens in the broader financial system, you have a tangible asset whose value is recognized worldwide. For those who already own metals, this may mean reassessing storage methods, ensuring access to the physical asset, and confirming the authenticity and security of holdings. For those considering entry, this is a critical step. Ownership without secure, verifiable possession is only half an investment. Next, diversification within metals should not be overlooked. Gold and silver are closely related, but they behave differently in specific market conditions. Gold is traditionally seen as the primary safe haven, offering stability and long-term preservation of value. Silver, while also a safe haven, carries an industrial component that makes it more volatile but potentially more profitable during certain cycles. Balancing exposure between the two allows investors to benefit from both stability and opportunity. Allocation should be based on personal risk tolerance, market outlook, and financial goals, but ignoring either metal can limit potential and protection. Timing and accumulation are also actionable areas. Historical patterns show that significant market moves often happen rapidly, and the best opportunities frequently appear when the broader public is fearful or uncertain. This is why strategic accumulation, buying during dips or periods of relative quiet, is essential. Waiting for confirmation of a market surge can result in missed opportunity or purchasing at inflated prices. A disciplined approach, one that plans purchases over time and accounts for market fluctuations, is far more effective than reactive buying or panic-driven decisions. Another actionable takeaway is monitoring macroeconomic indicators closely. Interest rates, currency strength, inflation trends, and geopolitical developments all influence gold and silver prices. Investors who watch these indicators can anticipate changes rather than react after the fact. For instance, signs of weakening confidence in fiat currencies or unusual central bank activity often precedes significant upward moves in metals. Paying attention to these signals allows investors to act with foresight and prudence rather than simply following market noise. Liquidity and flexibility are additional considerations, while holding physical metals is critical. It's also important to maintain a portion of one's portfolio in a form that can be quickly mobilized if opportunities or emergencies arise. This could mean having readily accessible physical metals, funds allocated for immediate purchase during dips, or a combination of both. Actionable strategy involves not just knowing what to buy or hold, but also being prepared to adjust positions quickly when conditions change. Risk management is an essential part of actionable takeaways. No market is without uncertainty, and precious metals are no exception. Price swings can be sharp, and external factors can create sudden shocks. Planning for worst-case scenarios, including extreme volatility or temporary price declines, ensures that an investor can remain calm and avoid emotionally driven decisions. Setting aside a portion of capital specifically for metals, maintaining diversification, and establishing clear thresholds for buying or selling can prevent costly mistakes. Knowledge without preparation is incomplete. Strategy without risk management is dangerous. Education translates directly into smarter entry and exit points. Those who understand market cycles, historical price patterns, and current economic signals can make decisions that balance opportunity with protection. For example, entering a position during a period of low demand, but rising institutional interest often results in favorable pricing, while recognizing when prices are approaching historically high levels can guide partial profit-taking or hedging. Actionable insight is not about predicting every short-term fluctuation. It is about positioning oneself advantageously based on evidence history and careful analysis. Finally, patience and discipline cannot be overstated. Precious metals often reward those who act strategically rather than impulsively. Rapid gains are possible, but sustainable wealth preservation and growth come from understanding trends, accumulating consistently, and avoiding emotional reactions to short-term noise. Actionable strategy requires a clear plan, adherence to that plan, and the willingness to adjust as conditions evolve, not based on fear or hype, but based on informed judgment. In essence, the actionable takeaway is this: owning gold and silver is only the beginning. How you manage, protect, and strategically grow your position determines the real value of your investment. Secure physical ownership, balance between metals, monitor economic indicators, maintain flexibility, manage risk, plan entry and exit points carefully, and exercise patience. These are not theoretical ideas. They are proven approaches that have preserved and increased wealth for generations. By following them, investors are not merely hoping for price increases. They are actively preparing for them and positioning themselves to benefit, regardless of how the market behaves in the short term. When the market signals are loud as they are now, the difference between those who act wisely and those who hesitate can be enormous. The actionable takeaway is clear. Don't wait for the headlines to tell you what you already know. Position yourself with knowledge, preparation, and strategy, and your gold and silver holdings will serve not just as protection, but as a powerful tool for financial security in uncertain times. Remember, gold and silver have always been the safe haven in times of uncertainty, and right now, those times are upon us. The key is not just owning these metals, but understanding the signals the market is sending. Stay informed, stay vigilant, and make your decisions based on knowledge, not fear. This isn't just about profits, it's about protecting your wealth in a world that's becoming increasingly unpredictable. Keep watching, stay prepared, and let's navigate this together.